So, India's central bank, the RBI, is about to do something huge. It's opening the floodgates and injecting an absolutely enormous amount of cash directly into the country's banking system. Make no mistake, this isn't some minor tweak. This is a massive financial rescue operation. And just look at that number. Let it sink in for a second. 2 lakh crore rupees. That's a 2 followed by 12. That's right, 12 zeros. It is a truly staggering amount of money, and it's all being deployed for one very specific, very urgent reason, to pump cash right into the heart of India's economy.
And that brings us to the big question, right? Why? Why is this happening now? What's going on behind the scenes that requires a rescue on this scale? Well, it's clear the system is thirsty for cash, and we're about to dive into exactly why that is.
So here's our game plan for this deep dive. First up, we'll tackle that 2 lakh crore question and figure out why the system is so thirsty for cash. Then, we'll unpack the RBI's brilliant 3-part plan to fix the problem. And finally, we'll connect all the dots and see what this economic ripple effect really means for you. All right, let's get right to the root of the issue. The entire banking system is facing what you might hear economists call a liquidity crunch. So, what on earth is liquidity? Well, it sounds complicated, but it's actually a super simple idea. Think of it as the ready-to-spend cash a bank has on hand for its day-to-day business. So if a bank has 100 rupees and lends out 95, it's only left with 5 rupees. That 5 rupees, that's its liquidity. And it is absolutely crucial for keeping the lights on. And when there's not enough of that ready cash, not just in one bank, but across the entire system, well, that's when you get a liquidity tightness, or in plain English, a cash crunch. And that is exactly the problem the RBI is jumping in to solve. So how did we get here? Well, it really boils down to 2 main things. First, banks have been on a lending spree, loaning out money very aggressively, which has left their own cash reserves pretty low. And second, the RBI itself has been playing a role. To keep the rupee strong, it's been selling US dollars, but to do that, it has to buy up rupees, which literally sucks cash out of the banking system. Okay, so that's the problem, a system-wide cash shortage. Now, let's get to the really interesting part, the solution. We're going to dig into the RBI's very clever 3-part plan to inject that 2 lakh crore and get the money flowing again. Now, the RBI isn't just writing one giant check. It's using a sophisticated toolkit, a combination of 3 powerful financial instruments. We're talking about open market operations, forex swaps, and something called a variable rate repo. Let's break down how each one of these actually works. First up, the big one. Open market operations, or OMOs. This is the real workhorse in any central bank's toolkit, and it's doing the heavy lifting here, responsible for a full half of that total 2 lakh crore injection. And here's the game plan. The RBI is rolling this out in 2 massive waves, 50,000 crore worth of government bonds on February 5th, and then another 50,000 crore on February 12th. That's a whopping 1 lakh crore coming from this single tool alone. So how does buying bonds actually put cash in a bank's pocket? It's surprisingly straightforward. See, banks hold a lot of government bonds as super safe investments. The RBI basically comes along and says, hey, we'll buy those bonds off you. The banks sell, and the RBI pays them in fresh, new cash. And just like that, boom, the banks are flush with liquidity. All right, on to tool number 2, the forex swap. Now, this one's a little more of a financial chess move, but it's a really smart way to add cash to the system without causing a big ruckus in the currency markets. Think of this as a kind of buy now, sell back later deal. Here's what happens today. The RBI takes US dollars from the banks and, in return, gives them Indian rupees. Instant cash for the banks right when they need it. But, and here's the swap part, there's a built-in agreement to reverse this exact transaction 3 years down the line. The RBI gives the dollars back and takes the rupees back. It's a temporary cash boost, perfectly timed. And that brings us to the third and final piece of the puzzle, the variable rate repo, or VRR. This one is all about speed, designed to handle those urgent, short-term cash needs. Imagine an auction, but instead of selling art, the RBI is auctioning off short-term loans. These are 90-day loans, and banks bid for them. Now, here's the twist. The winner isn't the bank that offers the most money. It's the bank that's willing to pay the highest interest rate on the loan. It's a competitive system that makes sure cash gets to the banks that need it most, and fast. So, the RBI is using these 3 powerful tools to flood the system with cash. But what's the end game? Why should any of this matter to you and me? Well, let's trace the economic ripple effect. At the end of the day, there are three main goals here. First, to simply ease the pressure on banks so they can operate smoothly. Second, and this is the one that affects us all, to bring down interest rates on loans. And third, to stabilize the super important government bond market. So here's the before picture, the situation right now. Because cash is scarce, it's more expensive for banks to get their hands on money. And guess what they do? They pass that cost straight on to you and me in the form of higher interest rates on car loans, home loans, you name it. But after this huge cash injection, the whole picture is expected to flip. With much more cash sloshing around, banks don't have to fight for funding, so their own costs go down. That, in turn, should push them to lower their interest rates to compete for your business, making borrowing cheaper for everyone. Now let's look at that bond market piece, because it's a really big deal. When the RBI goes on a buying spree for government bonds, the supply of bonds left for everyone else shrinks. Basic supply and demand, right? When supply goes down, the price goes up. And here's the key thing about bonds. It's like a seesaw. When bond prices go up, the interest rate they pay out, the yield, goes down. That drop helps pull down interest rates across the entire economy. So the RBI's plan is a powerful, direct move to keep India's economic engine properly oiled and running smoothly. It solves today's problem, but it also leaves us with a bigger question to think about. After quenching this immediate thirst for cash, what will be the central bank's next great balancing act on the horizon?